Hi everyone! So today's video is about Pinduoduo. A few of you asked for it in the comments after my JD.com video, and it's a good follow-up because Pinduoduo gives us another angle on China e-commerce. Not the heavy logistic model of JD.com, not the local services battlefield of Meituan, but a platform that scaled on price, engagement, and a very different set of economics. Alright, let's get into it. Pinduoduo is a pretty young company, and the timeline matters because the story is basically China domestic scale first, then a second engine abroad. The corporate entity was incorporated on April 20, 2015, and the Pinduoduo platform began commercial operations in 2015. 1 year later, in June 2016, the group acquired its main PRC operating entity, Shanghai Xunmeng, which is essentially the onshore backbone of the business. The next big step is capital markets. In July 2018, the company was renamed Pinduoduo Inc., and on July 26, 2018, it completed its IPO and the ADS started trading on Nasdaq. That's the moment Pinduoduo goes from fast-growing app to public company with a war chest. Then you get the first meaningful expansion beyond the original marketplace format. In August 2020, the group launched Duoduo Grocery, positioned as a next-day grocery pickup service, basically pushing the model into higher frequency consumption. And the second major inflection point is international. In September 2022, the group launched Temu, its global e-commerce platform founded and launched in North America in September 2022. From there, Pinduoduo becomes a two-engine story: the mature China platform plus an aggressively scaling cross-border platform. Now look at the revenue curve, because it captures how extreme the scale-up has been. Revenue goes from 0.5 billion RMB in 2016 to 393.8 billion RMB in 2024. That's roughly a 130% CAGR over 8 years. For 2025, the run rate is still moving up, but growth is clearly more normalized than the early hypergrowth years. In H1 2025, revenue was 199.7 billion RMB, plus 8.6% year-on-year, and Q3 2025 came in at 108.3 billion RMB, plus 9% year-on-year. That's the setup. Now let's simplify the model, because Pinduoduo doesn't work like a JD-style logistics machine. Pinduoduo is a marketplace-first model. Most products are sold by third-party merchants, and the platform's job is to generate demand, match it with supply, and make transaction frictionless. From the beginning, the positioning was value for money, with a shopping experience that feels more like discovery than pure search. This chart gives you the context. Pinduoduo didn't just grow, it took share in a market that used to look like Alibaba plus JD. By 2025 here, Pinduoduo is around 21.7%, JD is 16.6%, and Alibaba is down to 36.2%. And content platforms like Douyin are now meaningful e-commerce players too. So the market is more fragmented, more competitive, and more attention-driven. And Pinduoduo is one of the platforms that benefited the most from that shift. Now, how did it spread so fast? One early growth engine was team purchase. Users share deals, form a small group, and unlock a lower price, which helped distribution spread through social loops. Operationally, Pinduoduo stays relatively asset-light versus a JD-style model. Merchants handle fulfillment and typically use third-party logistics, while the platform provides the infrastructure, traffic, and rules of the game. Monetization is merchant-funded. In the company's own wording, revenues mainly come from online marketing services, merchant paying for traffic and conversion tools, and transaction services, fees linked to completed sales and related services. And this setup has a very direct financial consequence. Because Pinduoduo sits between customer payments and merchant settlement, it tends to run with structurally negative working capital, more like a platform with settlement float than an inventory-led retailer. On the chart, operating working capital in days of sales stays negative, but it moves closer to zero, from about minus 467 days in 2018 to around minus 144 days in 2024. In other words, the operating float is still there, but it's less extreme than it used to be. It's negative for a simple reason. Pinduoduo tends to receive cash before it pays out, and its operating current assets stay light. Two concrete drivers are merchants often prepay for ads, recorded as deferred revenue, and buyer payments are temporarily held in supervised accounts before being settled to merchants. Once you understand that plumbing, the P&L becomes easier to read. Merchants fund the model through traffic and ad tools, and Pinduoduo spends on payments, the tech stack, and merchant support to run the platform. This chart is the cleanest way to see the shift from buying growth to harvesting scale. In the early years, profitability is deeply negative. Then the curve flips. 2021 turns positive, and by 2022-2024, you're in a different regime. The simple interpretation is, once the marketplace is large enough, merchant monetization scales faster than the platform cost base, and Pinduoduo can choose how much of that profit to reinvest through incentives versus letting it drop to the bottom line. That brings us to the shareholder question. Does that operating leverage translate into earnings per share? On the EPS chart, what you are seeing is a shift from build mode to profit mode. In 2016-2020, EPS is still negative because the company is spending hard to scale. Then the model flips. EPS turns positive in 2021 and accelerates into 2024. One important nuance: the denominator changed a lot. The weighted average share count in 2024 is much higher than in 2016, roughly 1.8 billion shares back then versus 5.5 billion in 2024, mainly because of share insurance around the IPO and subsequent transactions, plus ongoing employee equity awards. And for anyone looking at the US listing, here is the technical point that matters. What you trade is an ADS. People casually say ADR, and one ADS equals 4 ordinary shares. So if a number is per ordinary share, you multiply by 4 to think in ADS terms. Finally, on the 2025 cadence, the company reported H1 2025 EPS of about 8.16 RMB per ordinary share, minus 24.9% year-on-year, and Q3 2025 EPS of about 5.24 RMB per ordinary share, plus 16.2% year-on-year. That's part 1, the model, the economics, and what the operating leverage looks like. Now let's switch to what changed recently, because 2025 is really about the policy angle. Before we talk about regulation, a quick note on geography. You might expect a clean split like China versus international now that Temu is global. But Pinduoduo doesn't really report revenue that way. Management presents the company as a single segment and says no geographical segments are presented because substantially all revenues are derived from within the PRC. So I can't show you a neat revenue by region chart like I can for some multinationals. What is very real, though, is the policy risk around the small parcel model. And Europe is the big 2025 headline. In 2025, the EU started moving toward charging and tightening controls on low-value parcels entering the bloc. The Commission floated a €2 handling fee per parcel, and the broader customs reform direction is to remove the €150 duty-free threshold and move toward an EU-wide mechanism for these flows. For Temu, the takeaway is simple. If cross-border parcels get treated more like real imports, unit economics can become less forgiving, meaning more pressure to localize inventory, reduce subsidy intensity, or accept slightly higher end prices in Europe. And this is where the balance sheet matters, because it tells you how much cushion the company has if this friction increases. On this chart, the first thing that jumps out is the cash stack. By the end of 2024, Pinduoduo is sitting on a very large liquidity buffer, roughly 400 billion RMB of cash-like assets in total. Now, the key nuance is how to interpret that cash. Part of it is not free cash the way you'd think about a classic industrial company. In Pinduoduo's model, money comes in from buyers first and then gets settled to merchants. And the company explicitly describes restricted cash as cash received from buyers that's reserved in a supervised account for payments to merchants. So yes, a slice of a cash pile is economically tied to a settlement cycle and should be treated conservatively as operating float, which is also why working capital is structurally negative in this kind of marketplace model. Now, that liquidity stack looks even more striking once you remember how light this business is. As we saw in the business model, this is exactly what you'd expect. Pinduoduo is not capital intensive. Capex is basically negligible because the company doesn't need to build and maintain heavy physical infrastructure to scale. Same message here. The platform owns very little physical asset base. Compared to a player like JD, where the model is tied to warehouses and logistics capacity, Pinduoduo stays light. It's a software and traffic business more than a hard assets business. This chart mostly reflects the model maturing. Once Pinduoduo hits scale, profitability expanded sharply. And because capex stays very low, a large share of its profits can convert into free cash flow. So, using the latest reported EPS prints, we get an LTM EPS of approximately 18.34 RMB per share. And remember the key technical point: one ADS equals 4 ordinary shares. So that's 73.36 RMB per ADS. Converting that into dollars, it's about $10.56 per ADS. So at today's price of around $104, that corresponds to an LTM PE of 9.85x. And just to be clear on shareholder returns, Pinduoduo doesn't pay dividends for now, and there is not a meaningful share buyback program either. So at this stage, the equity story is mainly about reinvestment and earnings compounding, not cash distributions back to shareholders. So to wrap this up, Pinduoduo is a very unusual e-commerce story. It's a marketplace model that scaled on price, discovery, and merchant monetization. And the numbers clearly show the outcome: strong profitability, strong EPS ramp, and an LTM multiple that looks reasonable. But my personal takeaway is more cautious. I'm not a shareholder, and I don't see this as a quality company to own long term. Even if the valuation doesn't look expensive on paper, I don't love a model that's heavily anchored in ultra-cheap goods, because that naturally comes with brand perception risk, quality risk, and a higher probability of regulatory friction over time. And that regulatory angle is getting harder to ignore. The small parcel model is exactly the kind of thing governments want to tighten. Europe is moving in that direction, and the same protectionist reflex can show up in the US and other countries. On top of that, cross-border commerce increases exposure to product compliance, safety standards, materials, ingredients, and those constraints can change fast and force the platform to adapt. One last angle I'd add is the macro backdrop, because it matters for how you interpret Pinduoduo's recent success. The last few years have been a pretty favorable environment for a trade-down model. In China, the property downturn and weak consumer confidence pushed people to optimize harder on price. And in the US and Europe, inflation squeezed a big part of the middle class. In that kind of cycle, a platform built around cheap deals can look unstoppable. But if the macro picture improves over the next few years, if China consumption normalizes, and if Western consumers get some breathing room, then that tailwind can fade. People don't trade down forever, and at that point, Pinduoduo may have to work harder on things like perceived quality, compliance, and brand trust to keep the growth engine running the same way. Finally, if you look at it through a shareholder lens, Pinduoduo isn't particularly friendly today. No dividends, no meaningful share buyback program, and while the balance sheet looks extremely liquid, a meaningful part of that cash is tied to how the marketplace settlement cycle works. So I'm not going to treat it like pure excess cash that automatically belongs to shareholders. And because the company is so asset-light, I also struggle to see a durable moat. This kind of playbook can be copied, and competition can always push the model back into a reinvestment subsidy cycle. So my stance is simple: I don't want to own it. Thanks for watching this deep dive until the end. If you found it useful, feel free to like, subscribe and share.